Assalamualaikum and hi, my name is Siti Mudrika Binti Ismail. Now let's begin with the introduction to today's topic. What is acquisition and payment cycle? Okay, the acquisition and payment cycle, also known as the purchases, payables and payment cycle, refer to a structure business process that involve acquiring goods or services and subsequently making payments to vendors. It plays a critical role in ensuring the accuracy, efficiency, and integrity of financial transactions related to purchases and disbursement. For acquisition class, this involves the purchasing of goods or services, typically including a debit to inventory or an expense and a credit to accounts payable. For cash disbursement class, this involves the payment of account payable, typically including a debit to account payable and a credit to cash. In conducting an audit, it is important to understand the relationship between the three main components, which is management assertion, audit objective, and classes of transaction. First class transaction is purchase transaction. The relevant assertion and audit objective is occurrence. Ensure recorded purchases actually occurred. For audit objective, to verify that the purchases recorded in the accounts represent actual goods or services received. Second, completeness. All purchases that occurred are recorded. For audit objective, to ensure that all valid purchase transactions are recorded in the period. Third, accuracy. Price, quantities, and amounts are recorded correctly. For audit objective, to verify that amounts recorded match the invoices and calculation are correct. Fourth, cut off. Purchases are recorded in the correct period. For audit objective, to ensure transactions are recorded in the correct accounting period, especially near year end. Last, classification. Transactions are recorded in the proper accounts. For audit objective, to ensure purchases are recorded under the correct general ledger codes, such as inventory vs office supplies. Second transaction is cash disbursement. For relevant assertion and audit objective, first, occurrence. Payment were made to legitimate suppliers. For audit objective, to ensure all cash payments recorded were actually made for legitimate liabilities. Second, completeness. All payments made are recorded. For audit objective, ensure no disbursement is omitted from the records. Third, accuracy. Payments match invoice amounts and correct accounts are affected. For audit objective, to confirm that payments were made for correct amounts. Fourth, cut off. Payments recorded in the correct period. For audit objective, to verify payments are recorded in the appropriate accounting period. Last, classification. Recorded under correct cash and payable accounts. For audit objective, to check payments are posted to appropriate accounts. Third transaction is purchase return and allowance. For relevant assertion and audit objective. First, occurrence. Returns and allowance recorded actually occurred. For audit objective, to ensure that the returns and allowance are valid and not fictitious. Second, completeness. All returns are properly recorded. For audit objective, to ensure that all goods returned are reflected in the books. Third, accuracy. Returns amount are correct and matched with credit notes. For audit objective, to verify the amount matched with supplier credit notes. Fourth, cut off. Recorded in the correct period. For audit objective, to ensure that returns are recorded in the correct period. Last assertion is classification. Recorded as reduction to purchase or inventory appropriately. For audit objective, to verify that returns reduce purchase or inventory amount properly or not miscoded as expenses.
Good morning, everyone. Today, I will be walking you through the key internal control and relevant account involving in the purchasing process. Focusing on the primary assertion is occurrence, accuracy, classification, cut-off, and completeness. Implementing strong control in each of this area is essential for maintaining financial integrity and operational efficiency. First, occurrence. Let's begin with occurrence. This assertion ensure that purchasing recorded actually occurred and related to the entity. The relevant account here is include account payable, cash or bank, inventory, and purchases. The internal control measure we use to support occurrence is ensuring that all purchase requisition and order are properly authorized by the appropriate personnel before any acquisition is made. This step help prevent unauthorized or fictitious purchases, maintain the reliability of our record. Next, we go to the accuracy. Accuracy ensure that the purchase transaction are recorded at the correct amount. The relevant account related to the accuracy is account payable, cash or bank, inventory, purchase, freight in, purchase discount. The corresponding internal control involved is reviewing and approving all purchase order by authorized personnel before the processing happen. This include verify quantity, price, and payment term to ensure that everything is correctly stated. This process help eliminate costly error and ensure our financial record are precise. Then we go for classification. Classification which ensure that all transactions are recorded in the appropriate account. The relevant account that related to this is account payable, cash or bank, inventory, purchase, and return purchase. To support this, we implement the following internal control. We use a standardized chart of account that clearly define each account and its purpose. This standardization ensure consistency in how transactions are recorded and reported. Moving forward is a cut-off. Starting with the cut-off assertion in the purchase process. This ensure that transactions are recorded in the correct accounting period. The relevant account that related to the cut-off is account payable, cash or bank, inventories, purchases, expenses account, accrued and prepaid expenses. The internal control supporting this assertion is the timely recording of vendor invoice upon receipt. This ensures that expenses and liability are recorded in the proper period, safeguarding financial accuracy. Next is a completeness. Now, on to completeness. This assertion ensure that all valid transactions are recorded. The relevant accounts are similar. Account payable, cash or bank, inventory, purchases, return purchase, and purchase discount. The internal control here involve regular bank reconciliation by comparing company record with bank statement. We can ensure that no transaction are omitted or lost. We go for cash disbursement. Let's discuss the occurrence in the cash disbursement cycle. This confirms that recorded disbursement actually happened and related to the entity. Relevant account involved include is account payable, cash or bank, inventory, purchases, return purchase, and purchase discount. The internal control in place is segregation of duties, specifically separating the role of authorizing purchases, receiving goods, and processing the payment. This control significantly reduces the risk of fraud and error. Next is a completeness. In cash disbursement, completeness ensures that all payments are fully recorded. The relevant account remain the same. Here, internal control is achieved through the use of sequentially number purchase, requisition, and orders. This help track every transaction, preventing omission and enabling easy identification of any missing document. Accuracy in cash disbursement is vital to ensure that all payments are made correctly and in line with the company financial record. The key account involved under this aspect include account payable, cash or bank, inventory, purchases, return inward, and purchase discount. To maintain accuracy, internal control must be in place. One of the most effective control is to match check with corresponding purchase order and receiving report. This process helps identify any discrepancies early and allow us to take corrective action before the payment is finalized. Next is classification. We move to classification, which refer to correctly categorizing each disbursement into the appropriate financial account. The relevant account for classification include account payable, cash or bank, inventory, purchase expenses, accrued and prepaid expenses. Proper classification ensure transparent and accuracy in financial reporting. Therefore, it's essential to develop and maintain comprehensive accounting policy and procedure. This should include clear guidelines for the proper classification of each transaction, helping to reduce error and improve consistency. Next is a cut-off. We consider the cut-off aspect, which ensure that transactions are recorded in the correct accounting period. This prevents misstatement in financial report, especially at month or year end. The account involved are similar to those under classification, including account payable, cash or bank, inventory, purchases, expenses, and accrued expenses. Here, internal control is about ensuring that all receiving report and check are complete and recorded promptly upon the receipt of good or service and payment. This help maintain accurate timing in financial entry and avoid any potential delay or error in reporting. Purchase return and allowance. We will explore the section under this point. We consider occurrence, which ensure that all purchase return or allowance actually happen and are legitimate. The relevant account here include account payable, cash or bank, inventory, purchase return and allowance. To verify occurrence, internal control require that all goods be inspected upon receipt. This is to confirm that the item received match the purchase order and are in acceptable condition. Any discrepancies should be identified immediately to support valid return claim. Next is a completeness. We focus on completeness, which ensure that all return and allowance are fully recorded in the financial system. Again, the relevant account are the same. Account payable, cash or bank, inventory, purchases, purchase return and allowance. The key internal control here is to regularly reconcile the account payable sub-ledger with the general ledger. This help confirm that all return adjustment are accurately captured and no transaction is left out. Next, we move to the classification. We look at the classification which ensure that return and allowance are properly categorized in the correct account. Relevant account that related to the point above is an account payable, cash or bank, inventory, purchase return and allowance. To strengthen this process, company should implement a secondary review by supervisor or manager. This added layer of oversight help verify the correct classification of each return transaction, reducing the risk of misstatement. Cut off. This refers to the proper timing of recording return. It ensures that all transactions are reported in the correct accounting period. Relevant account involved here include account payable, cash or bank, inventory, purchase return and allowance. The key internal control to support this is the immediate entry of debit memo into the accounting system as soon as the return occur. This ensures that every return is reflected promptly and accurately in the period it belongs to. It will help maintain the integrity of financial reporting. Let's move to the accuracy, which ensure that all return value and detail are correct and supported by documentation. Relevant account that related to the point is account payable, cash or bank, inventory, purchase return and allowance. To ensure accuracy, internal control must focus on verifying debit memo against 3 documents: the purchase order, the receiving report and the vendor invoice. This cross-verification process help confirm that the return is valid, correctly priced and properly approved.
Assalamualaikum, my name is Erli Mirza binti Rosli. Now let's look at the two main types of audit procedure, which are test of control and subjective test. We begin with the test of control, type of audit procedure that we perform in order to evaluate whether the client internal control work effectively in preventing or detecting risk of material misstatement at the execution level. Reduce subjective audit procedure and obtain additional audit evidence. Next, we have the subjective test. Subjective tests are audit procedure that examine the financial statement and supporting documentation to see if they contain error. These tests are needed as evidence to support the assertion that the financial record of an entity are complete, valid and accurate. In contrast, subjective tests focus on the actual amount record and reported in the financial statement. First is purchase transaction. The objective is confirming that our purchases are accompanied by the appropriate paperwork, including invoice and purchase order. We have 5 sections in test of control. First, occurrence. Examine document in voucher package for existence. Second, completeness. Examines bank reconciliation and observes the preparation. Third, classification. Examine the procedure manual, the chart of account, and the indication of internal verification. Fourth, cut off. Observe whether unrecorded vendor invoice exists. 5. Accuracy. Examine proper approval for purchase, requisition and order, as well as internal verification and the recording of purchase transaction. Next is subjective test. First, occurrence. The inspection process involves approving and validating selected transactions from the purchase journals based on the presented supporting document. Second, classification. Compare classification with charge of account by referring to vendor invoice cessation. Third, completeness. Trace from a file receiving report and file of vendor invoice to the acquisition journal. Fourth, cut off. Compare date of receiving report and vendor invoice with date in the acquisition. Fifth, accuracy. The task involves approving suppliers' invoice for related purchase, tracking them to recorded purchases, and ensuring accurate record keeping. Next, we talk about cash disbursement transaction. The objective is how the company pay its bill, whether it has been following its internal regulation, and whether it records the payment in compliance with the relevant accounting standard. First exertion is occurrence. Test of control. Observe the separation of duty and the independent reconciliation of bank balance. Subjective test. Trace the whole transaction starting from the cash payment journal to the bank statement. Second exertion is completeness. Test of control. Account for subsequent of check and examine bank reconciliation. Subjective test. Trace good receipt note or supplier's invoice to entry in the purchase journal and account payable ledger. Third exertion is cut off. Test of control. Examine the procedure manual and observe whether an unrecorded check exists. Subjective test. Compare date on cancelled checks or electronic bank record with the cash disbursement journal. Now, we have two more key of the exercise for cash disbursement transaction is classification and accuracy. Classification, test of control. The task involves reviewing the procedure manual and the chart of account as well as examining the indication of internet verification. Subjective test. Compare classification with the chart of account by referring to the vendor invoice cessation. Lastly, accuracy, task of control. The task involves examining internal verification indication and observing the preparation of bank reconciliation. For subjective test, compare cancelled check and electronic bank record of disbursement with the related acquisition journal and cash disbursement journal entry. Last, let's talk about purchase return and allowance. The objective is the transactions are accurately recorded, properly authorized, and compliant with the entity policies and relevant accounting standard. We check this through two key exertions, accuracy and completeness. First, accuracy. As test of control, we check in to make sure the recorded allowance and purchase refund are real and pertain to the entity and that they are not fraudulent. For subjective test, we examine supporting documents such as returns authorization form, credit memo, and supplier respondents to ensure the transactions are legitimate. Second, completeness. For test of control, we confirming that all purchase return and allowance that should have been recorded have indeed been recorded, ensuring that no transactions are omitted. For subjective test, We reconcile the purchase return and allowance entry in the subsidiary ledger with the general ledger and financial statement. There are three more key audit associations for purchase return and allowance is classification, cut-off, and accuracy. Third is classification. As a test of control, ensuring that purchase return and allowance are properly classified in the financial statement, reflecting the nature of transaction. Subtlety test. Review the presentation of disclosure of purchase return and allowance in the financial statement to ensure they are appropriately classified and disclosed. Fourth, cut-off. Test of control. Ensuring that purchase return and allowance are recorded in the correct accounting period, especially those occurring near the end of the period. Subtlety test. Compare the date of the credit memo and return authorization with the date recorded in the accounting record to ensure proper period reconciliation. Fifth, accuracy. Test of control ensuring the accurate recording of allowance and purchase return in the correct accounts and at the correct amount. Subtlety test. Recalculate the return and allowance amount, including any restocking or return shipping charge, to be sure they are calculated accurately.
Hi, Assalamualaikum. My name is Nazifa Anisha. Now I will explain about audit evidence related to substantive tests. What is audit evidence? Audit evidence is all the information used by the auditors in arriving at the conclusion on which the auditor's opinion is based. It includes both information contained in the accounting report underlying the financial statement and other information obtained from various sources during the course of the audit. According to the MIA, Malaysian Institute of Accountants, audit evidence must be sufficient and appropriate. Sufficient is the quantity of evidence gathered must be adequate to support the audit findings. Appropriate, the quality of evidence must be relevant to the audit objective and reliable in nature. Next, audit evidence for trade transaction. First, purchase transaction. Evidence needed was purchase order. Inspect purchase invoice to verify that goods or services were received and invoiced correctly. Second is supplier invoice or GRN, good receipt note. Reconcile PO and GRN to ensure consistency between purchase order, good receipt notes, and supplier invoice. Lastly is supplier statements. Analytical procedures to compare purchase amount to prior periods and expectation. Second is cash disbursement transaction. Bank statements, check copies, and transfer slip was evidence needed. Examine all the payments evidence to compare all payments evidence with the invoice, PO, and GRN to ensure they match. Next is payment voucher to confirm that each payment is authorized and supported by valid invoices. Lastly is payment approval. Trace payments to verify that payments are recorded in the correct accounts and periods. Next is purchase return and allowance transactions. Evidence needed was credit or debit memos. Review the memos to ensure credit or debit notes are issued for returns and the amounts are valid. Next is return merchandise authorization, RMA. Document that approve the return of goods to suppliers. Next is supplier correspondence. Inspect supplier correspondence and verify returns and allowances with supplier communications and confirm that purchases are recorded in the correct way. Possible misstatement. Possible misstatement refer to any disparity, error, and fraudulent manipulation in the financial record of a company that could result in the financial statements being inaccurate and misleading. This misstatement, whether due to human error, fraudulent activities, or improper application of accounting policies, can have a significant impact on the accuracy and reliability of the company financial reports. Identifying and correcting possible misstatements is a critical part of the audit process, ensuring that the financial statement provide a true and fair view of the company financial position and performance. Possible misstatement for purchase transaction. Assertion of occurrence. Possible misstatement is a purchase is recorded in the book, but the good or services were never actually received. The impact of the possible misstatement was led to a misleading increase in expenses and liabilities, which can understate profit and inflate liabilities. Next is accuracy. Possible misstatement is incorrect invoice amount and inaccurate recording of accounts. So the effect is financial statement reflect inaccurate liabilities or expenses, affecting cost of goods sold, gross margin, and vendor reconciliations. Next is classifications, which is the possible misstatement was incorrect classification of account. So the impact was result in misclassification of operating versus capital expenditure, affecting net income, depreciation schedules, and asset bases. Next is cut-off. So the possible misstatement is a purchase that acquired before period and is recorded in the next accounting period. So the impact is period and balances become inaccurate, affecting COGS, cost of goods sold, liabilities, and inventory reporting. Lastly is completeness. Possible misstatement was a valid purchase was made and a good received, but the transaction was not recorded, often due to the invoice not being entered or received. So the impact was misstates the financial position. Liabilities are understated, which may make the entity appear more solvent than it really is. Next is cash disbursement transaction possible misstatement. Occurrence. Possible misstatement is a cash disbursement is recorded in the books, but no actual payments was made. So the impact was false reduction of liabilities, overstatement or expenses, resulting in a misleading financial position and net income. Secondly is accuracy. So the possible misstatement is the amount of cash disbursed is recorded incorrectly. The impact was incorrect reporting of cash balance and expenses, impacting liquidity analysis and financial ratios. Next is classification. Possible misstatements was a cash disbursement is recorded to the wrong account, so the impact was skewed expenses analysis and budgeting reporting, misleading management decision based on department or functional spend. Next is cut off. So the possible misstatements of payment made in one period. So the impact was improper cut off leads to the misstatement of the period and balances, impacting the accuracy of financial statement. Lastly is completeness. So the possible misstatement was a valid payment was made, but it was not recorded in the book due to processing error, system failure, or fraud. So the impact was overstatement of cash and liabilities, leading to misrepresentation of financial health. Lastly was a purchase returns and allowances transaction possible misstatements. First, occurrence. Possible misstatements for occurrence was a purchase return is recorded, but the goods were never actually returned to the supplier. So the impact was mislead user into believing costs are being recovered or inventory is lower, creating an artificial improvement in profitability. Next was accuracy. So the possible misstatement was the amount or quantity of the return recorded is incorrect. So the impact inaccurate recording affect financial accuracy and can distort profitability or working capital. Next was classification. Possible misstatements was the purchase return is posted to the wrong account. So the impact was misleading presentation of financial statement. Expenses and return figure become inaccurate, affecting analysis of procurement or sales trends. Next was cut off. So the possible misstatement was a return related to the one period is recorded in a different accounting period. So the impact was financial statement for the affected periods lack accuracy, especially critical for year-end audit and tax reporting. Lastly was the completeness, so the possible misstatement was a valid return to the supplier is not recorded, either due to the oversight system error or internal control failure. So the impact was causes overstatement of expenses and liability, under-reporting the business profitability and skewing performance ratios.
Now, for the task 2, we have prepared past year question which we choose from February 2021. The question is, you are carrying out the audit of the purchase system in Reka Home Furniture, which has around 50 million amount of revenue per year. The company is owned by Mr. and Mrs. Kwok, and they are not involved in running the business on a daily basis. Standard accounting system of the company was purchased from an independent supplier. Mr. and Mrs. Kwok are aware that there may be deficiencies in the purchase system and suggested that you audit the purchase system. Below are some of the findings from your audit. A. When materials are acquired for production, the production manager send a handwritten note to the buying manager. The buying manager then find a suitable supplier and raise a purchase order. The purchase order is signed by production manager. B. Materials purchased for production are received by the receiving department, which issue a good receive note JRN and send a copy to the bookkeeper. C. The bookkeeper receive the purchase invoice, match it with the good receive note and purchase order if available. The production manager authorize the invoice for posting to the purchase ledger. D. The bookkeeper analyze the invoice and post it to the purchase order. E. At the end of each month, the bookkeeper prepare a list of account payable to be paid. This is approved by the production manager. F. The bookkeeper prepare the check and remittance and post the transaction to the purchase ledger and cash book. Last, G. The production manager sign the check and the bookkeeper send the check and remittance to the suppliers. Okay, for the first finding, A. When material are acquired for production, the production manager send a handwritten note to the buying manager. The buying manager then finds a suitable supplier and raises a purchase order. The purchase order is signed by production manager. For possible internal control witness, purchase requests are made using handwritten notes from the production manager to the buying manager. Impact of the witnesses to the company or organisation. Handwritten notes are informal, may be lost or misinterpreted, and make it difficult to trace authorization, leading to potential unauthorized or duplicate purchases. Suggestion to rectify the weaknesses. Implement a formal and standardized purchase requisition form, preferable through a computerized system to ensure consistency and traceability. Okay, second finding is materials purchased for production and received by the receiving department, which issue a good receive note JRN and send a copy to the bookkeeper. Possible internal control weaknesses. There is no mention of segregation between purchasing, receiving and recording functions. The receiving department sends the JRN directly to the bookkeeper, which may allow collusion or undetected error. Impact of the witnesses to the company or organisation. Potential impact: poor segregation of duties increase the risk of fraud, such as employees colluding to create fictitious purchases or overstate inventory. Suggestion to rectify the witnesses. Different staff should handle purchasing, receiving and payment tasks. This reduces the risk of fraud and error.
Next, the third finding is the bookkeeper received the purchase invoice, match it with the good receipt notes and purchase order if available. The production manager authorized the invoice for posting to the purchase ledger. First, possible internal control. Incomplete matching for the purchase order, good receipt note and supplier invoice. Second, impact of the weakness to the company or organisation. Without complete three-way matching, the company risks overfine supplier, making duplicate payment, and paying for good not received. Last, suggestion to rectify the weakness. Apply straight procedure to ensure three-way matching is performed for every purchase before payment is processed.
The question is the bookkeeper analyze the invoice and post it to the purchase ledger. In possible internal control weakness, there are detect lack of segregation of duty. The bookkeeper both analyze and post invoice without independent verification. To supervisory review of the accuracy and validity of invoice before posting. The impact of the weakness is increase the risk of error or fraud entirely going undetected. Potential for unauthorized or duplicate payment. Financial record may become inaccurate, impacting decision making and reporting. Suggestion to rectify the weakness, implement segregation of duty. One person should analyze the invoice and different person should post it to the ledger. Introduce supervisor approval before invoice are posted. Conduct predictive internal audit or spot check of post invoice to ensure accuracy and compliance. Question is, at the end of each month, the bookkeeper prepare a list of account payable to be paid. This is approved by the production manager. Possible internal control weakness is the production manager who is involved in purchase also approve the payment list, which create a conflict of interest. The bookkeeper prepared the payment list without independent validation or cross-checking. Impact of the weakness is potential for fraud payment to unauthorized supplier, increase of risk of payment error, and limited oversight could lead to misappropriation of fund. Suggestion to rectify the weakness is payment list should be reviewed and approved by an independent party such as senior finance officer or internal auditor who is not involved in the purchasing process. Introduce a three-way matching system such as purchase order, good receipt note and supplier invoice to validate all payment. And lastly, implement automate payment control and require dual signature for payment above a certain threshold.
Question F. The bookkeeper prepares the checks and remittance and posts the transaction to the purchase ledger and the cash book. So the possible internal control weakness. First, lack of segregation of duties. Same persons prepare the checks and same persons record the transactions. Next is no independent review or authorization of payments. So next, for the impact for the company, first is high risk of fraud and unauthorized payments. Next is a potential manipulation of the purchase ledger and cash book to conceal theft and errors. Lastly, suggestion to rectify the weakness. First, segregate the duties. One person should prepare the checks and another should record the transaction. Second, implement mandatory supervisor approval before the check preparation and posting. Lastly, was introduced periodic independence review by senior finance personnel. Last question. The production manager signs the checks and the bookkeeper sends the checks and remittance to the suppliers. Possible internal control weakness. First, authorization of payments by personnel not in the finance or accounting departments. Second, no independent oversight of check signing and disbursement. Impact on the company. The first, increased risk of unauthorized, invalid or non-businesses related payments. Second, lack of accountability in the disbursement process. Lastly, suggestions to rectify the weakness. First, assign check signing authority to a senior finance officer. Second, require dual signatories for all payments above a threshold. Lastly, ensure checks and remittance are sent by someone not involved in the check preparation. That's all. Thank you.